everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Roster with Victory Fiduciary, and today we're getting into the second trading week already of January 2021. It's been an eventful year, certainly so far, and I'd say though within the market, things have been really just kind of moving along as we expected. Not a whole lot of things have really changed since we spoke last week. Yesterday we saw the broad-based markets have a little bit of a pullback, but again, not unexpected. I know it seems like they can, but markets can't just advance every day. They have to have times where they pull back. Yesterday's pullback was really hardly anything, almost like just like a little blip. But again, price action, performance has been very strong, very positive in January for the most part so far across all the major indexes. So the one thing though that I did want to talk about today was the dollar. And so this is something we've been keeping an eye on really for months. And so you can see back as the pandemic spiked, the dollar spiked. Obviously, it's kind of like a risk-off move, and so people went into the dollar. And then we've just had a really significant decline in the dollar down here. And then so here's our moving averages, our 50 and 200 moving day average. We are trading well below these lines of support right now. And so one of the things that we've been saying though is that when the dollar does finally begin to kind of make its rally, that will probably negatively impact equity pricing. It may be good for bond pricing, but for equities, it'll put pressure on them, certainly. And so we just now are starting to see a bit of an uptick. It actually put the dollar on in some areas on a buy signal. So again, just something that we're looking at, just starting to kind of uptick now. We'll see if it holds, and if that kind of continues, it'll just be something worth watching. Because like I said, a stronger dollar will put pressure on equities, especially international equities. So just kind of something to think about. But I thought it was interesting as we've been looking at this, just kind of seeing those movements. And again, if we can just really quick kind of get into what the other broad-based markets are doing though. So here's our S&P 500, and as you can see, so we have been really just kind of riding along our being traded significantly deviated from our long-term moving averages. And so we've just been kind of here. We're really just kind of riding that stimulus wave, riding that momentum. Right now, as I said last week, kind of everybody's all in to the market. Everybody's on the same side of the boat. Really not a lot of people are taking risk off right now. Everybody's kind of all in. And so prices have continued to march onward. And so as I said last week, that will happen, and I talk about this in my blog, until suddenly they don't anymore. And what causes those reversions to happen, we never know. That's the whole idea of them. They kind of trip us up and catch us off guard. They catch the market off guard. So just things to think about. Certainly S&P's kind of continued with its advance. So what I wanted to talk about today, because within the market itself, it's Tuesday right now. I am recording this a day early, so I guess things can happen in the next 24 hours. But as of Tuesday, not a whole lot has been going on necessarily within the market. We haven't seen huge changes or shifts or momentum swinging, kind of keeping on with the same theme. So I wanted to go a little bit of a different direction. So last night, standing in my kitchen at my island, and my husband and I were talking about the pricing and valuations of stocks and how the market continues to be overvalued. And we were talking about companies, that are fairly well known, and we were talking specifically about Apple. My 11-year-old's ear kind of perked up. He just got a new to him iPhone, and so he said, "Oh, well, how could Apple ever lose money? They always make such great products." It was just a very interesting question. And so I started trying to explain to him just how the stock market works. And halfway through, as I was explaining to this, and I was very proud of myself for this explanation, I think he was probably pretty bored, but he listened. And as we were talking, I was thinking, this might be a easy way. I know there's a lot of investors who still really don't understand the basic premise of how the market works. Maybe you've been investing in your 401k since you were in your 20s, but never really quite understood the idea, or you've had an IRA but just didn't understand. I thought maybe today we could just spend a couple minutes and kind of talk about really how the market works in general. You've heard me use the term supply and demand before, right? So everything in the market is driven by supply and demand. So here's how it works. These just so happen to be sitting on my island in a basket, and so I was using these to explain to him. And so here's really the basic premise of how the market works. If people decide that they want to buy oranges now with the hopes of being able to sell the oranges later on at a higher price, that would be people are investing in oranges. So if you go to the grocery store and now people are investing in oranges, so let's say people are buying oranges for $1 right now, but there's only so many oranges that can be bought, and there's a whole lot more buyers than there are oranges. It's going to cause the price of the orange to have to go up. Supply will take over. Demand will take over. There's more people who want the oranges than what we have, and so that drives prices up because there is a significant amount of demand. Okay, so people are spending $1, now they're spending $3. So eventually, these oranges continue to go up in value because people are willing to pay that price for them. And again, all with the hopes that they'll be able to sell these long down the line, whether tomorrow, next week, next month, next year, for a higher price. Okay, so lots of people want them. There's interest. There's not an infinite amount of oranges. That means that the prices are going to rise. So let's say today you spend $3 for an orange with the hopes that maybe next week you'll be able to sell it for $5. But then something really crazy happens, and all of a sudden, these oranges are selling for $36, $37 an orange. Now, you know that there's probably no real basis for being able to justify paying that, except for that's what the going rate of the orange is. And that kind of is like where we are within the market. We're trading at 36 times earnings right now, which basically means stock valuations, nobody's really interested in that. They're buying whatever the stock is listed at because it keeps going up. But there's nothing really tangible to kind of back up or defend why that is trading. But right now, people are willing to pay that price. They're willing to pay 36 times earnings. People are willing to buy $36 an orange with the hope that the value will continue to go up so that they can sell it later for a higher price. Okay, so lots of investors, limited amount of oranges. Now, this continues on. Now, what I said in my blog last week is that people will continue to be willing to pay this price until one day they're not. What causes that to happen? It's usually an external exogenous event that nobody was expecting. So in 2020, it was finding out that the pandemic, not only was it here, but that we were likely going to have shutdowns and there was going to be some significant financial implications to the United States itself and, of course, across the world. So let's say, though, we find out that there's going to be a huge export tax on oranges that we weren't expecting, that wasn't here before, and now it's coming. Well, now all of a sudden, that $36 orange, investors are starting to have a tough time being able to defend why they're paying that. And there is a whole slew of selling that happens. People all of a sudden say, I got to sell my oranges. I don't want to hold these oranges anymore. I have to sell them. And suddenly, if you have more sellers than buyers, that's going to drive the price down. Because now a buyer might say, all right, I'll buy your orange that you bought for $35. I'll give you $5 for it. And you will have to make the choice. Am I willing to take a loss on my orange or my stock to have somebody take it? Or am I going to hold it and hope that the value of the oranges will go back up? And so sometimes what happens is people say they move from oranges maybe to apples. They move to a whole different area of portfolio. Risk on, risk off. They go from offense to defense, whatever it is. But that's really how supply and demand works in the market. It's all about what buyers and sellers are willing to buy and sell for, and it all has to do with demand. It also has a lot to do with when we track momentum in the market. That's all we're tracking. We're tracking, in general, are more people coming in and buying a stock or more people coming in and selling it. And you can kind of chart those supply and demand ebbs and flows, and you can get a good handle on areas of the market that are strong, that look like they will continue to be strong, versus the areas that are weak and that will likely be laggers and not have strong relative strength. It's really, it's how that works. The other thing, too, that relative strength and momentum helps us with, let's say, some people are just investing in oranges across the board. No matter what kind of oranges they are, they're just buying all of them. So that might be like somebody who just kind of puts their money everywhere across the market without really knowing why they're buying what, why they are purchasing the stocks that they are. If you're using relative strength, you may say, well, I know these oranges are overvalued, but maybe I can be very careful and I'm only going to pick these very specific oranges, and because maybe they have a certain smell or a certain taste. And again, I'm being very ultra simplistic here, but that's the idea, that instead of just buying any orange or all of them, I'm going to be very specific about the areas that I buy because I think they're going to be more valuable. I think that they will hold up their worth better if we have a sell-off. That's the idea of relative strength and using positive momentum. Instead of just kind of arbitrarily putting our money across the board, we are very tactically, very targeted, choosing what areas we're willing to purchase and what areas we're steering clear of. And so I hope that was somewhat helpful for you. Again, I had this conversation. I thought, hey, maybe that would be something simple to kind of explain to investors, because it is important for you to understand how the market works. It really is. It's an exchange. It's a market exchange of buyers and sellers all day long. People willing to buy, people willing to sell. But what happens is if and when, and it will happen, at some point we are going to see a reversion of prices. It kind of has to. What's going to trigger that? We don't know. How significant will the reversion be? We're not sure. But what happens is typically we have a bullish sentiment where everybody just thinks everything can only go up. And at some point, those floodgates will probably change and we'll have a rush of sellers. So the idea is making sure that you understand where you're allocated and why, and then that should help guide you through that next situation. And so lastly, I just kind of wanted to, I haven't done this in a while, share my contact information with you. So if you have questions about things we talked about today, I'd love to hear what your thoughts are regarding supply and demand. Here's our website. All of our blogs are there. We blog at least once a month, so you can go back and kind of read through them. Phone number and my email. I'd love to hear from you. So that's all that I wanted to get into today. I thank you so much for your time. We'll see you next week. Stay well.